Hi everyone, so this is part 2 of the video. We will now continue with the rest of the accounting rules. So we go back to this summary worksheet. We ended with consistency. So now we continue with the matching principle. So what is this matching principle? The key idea, we are now in matching. The key idea of this rule is that revenues and expenses should be in the same period. So, what's the example of this? You can quickly see here a very clear example of what this principle or this rule is all about. The first one, sales should be matched with the expenses of the same year. Right? So that is the thing here. In accounting, we make sure that whatever we spend in 2019, for example, should be recorded in 2019. We make sure that all our records are being done on a timely basis. On a timely basis. It means that we don't forget recording transactions every single day so that we keep track of all the records properly. Remember, we always go back to the main purpose of accounting. We say accounting is the language of business. So, therefore, we make sure that all our records are accurate so we can easily tell if the business is doing well or not. So in here, if you are already in 2017, then you should not record previous expenses this year. Well, technically in higher accounting, there is a way to record the old expenses or old income. We can still record them, but it's part of a more complicated way of accounting. And in your syllabus, it's very simple. We just follow the basic way of how to do it. We follow matching principle. We match the same year expenses and income, right? That is matching. Key idea, we record revenues and expenses in the same year that they are incurred or that they are paid or that they are received. So I hope that's clear for the matching principle. So a quick run through, we've already done since part 1 of the video. Business entity means the business is separate from the owner. Duality is the use of debit and credit. Okay, money measurement, we only record transactions in accounting records which has monetary value. It can be dollar, it can be euro, it can be real, depending on which country, it's fine as long as it can be measured in terms of money. Realization, don't forget the pizza example. The pizza needs to be received first by the customer in order for us to record a sale or that there is really a transaction going on. And we only record profit when it is earned. Next, consistency. We use the same method every single year. I've explained that before. And then matching, we just did it now. Revenues and expenses should be the same period. All right. Prudence. So in prudence principle, we are now at the seventh principle. So in the seventh principle, prudence, this is the most popular principle or rule in all of the accounting rules. It simply means we do not overstate our assets and our profits, and we do not understate our losses or expenses. So this is it. I'm going to highlight it. It is also known as the principle of conservatism. If you think about it, the word conservative means, if you're told, like, we conserve water, we conserve energy, we don't waste energy, we don't waste resources. So in accounting, we are conservative. We don't record income unless we really have incurred it. We don't overstate. You don't you don't put in your books, oh, my asset is 1 million, when in fact it's only 300,000. All right. So, what are the examples of prudence? The best example here is your bad trade receivables. So, if you can recall, trade receivables are customers who pay you later. But what happens if, you know they run away from you? So you are not able to collect the money. When you first, I'll write an example here. The first time you sold the goods and you're so happy about it, you debit trade receivable. And then you credit sales. And sales is an income. Trade receivable is an asset. So if you look at this, your assets increase, okay? And your sales or your income also increase. But then, what happens if this specific customer did not pay you? So technically, there is no asset and there is no sale. Yeah? So we have to remove this from the books. On a normal transaction, I'm sorry, that's the bell. Okay. So on a normal transaction, if the trade receivable paid you, you should have debited cash or bank, right? And you have credited trade receivable. That is when the time when the trade receivable actually pays you, or the customer pays you back. What happens if he turns bad? So if it turns bad, you can no longer debit cash or bank. You are now going to record debit, doubtful, sorry, bad, that's expense, and credit, trade receivable. Okay, in short, this will now make sure that you recorded things properly. So the bad debt expense, your expenses will go up. Yeah? So if your expenses go up, then naturally it will not overstate your profit. Initially, you recorded a sale here. Yeah? You recorded a sale. Then you realize that this is not happening because you are not actually collecting from that customer. So you remove that income account, a credit, and make it into a debit, bad debts expense. So instead of charging it to a income account, you are now making it as an expense. Okay, I hope that's clear. I'm just changing this. Sorry about that. Okay. So I hope that's clear what I'm trying to say. You are now removing that income and putting it into an expense account. When you are doing this process, you are actually applying the prudence principle because you are not overstating your profit and your losses are not understated. You are recording them properly. Okay, so that is prudence. The next one is going concern. For the going concern, it's a very simple rule. It means that unless otherwise, that the business shows or declares that it is closing down, then we make a specific assumption that the business will continue to exist. All right? Even though the business suffered a net loss or whatever loss is that, it means still that the business will continue to exist. So let's look at the examples here. Oh, sorry, here. It's the notes here are no intention to close down in the near future. So even though there's a net loss of 2 years or 3 years, if if there is no intention to close down, then it means that the business will continue to exist. So let's look at the examples. The first one, cut workers by 10% is an example of going concern. Because, of course, 10% is not really a big thing, okay, especially what's happening now. We have the pandemic now, coronavirus. So most businesses cut workers. If it's just a small cut, for sure it's just a way to operate more efficiently. So it's not really an example of going concern. Oh, sorry, it's an example of going concern because it means you will continue to exist. Now, if you cut your workers by 80%, that's a big thing. So it means that you are no longer going to exist for a long time, or you have the intention to close down, because 80% of the workforce being cut is a big thing. Okay, so that is going concern. It means we make an assumption that the business will continue to exist with no intention to close. All right, last three, materiality is another principle. It simply means that items of low value are not worth recording as separate business. So let's say you have a small business, you have one laptop. Do you think it's worth recording separate? Okay, yes. So worth recording separate. How about if you are a large business? Yes. Do you think if it's a large business, then a laptop is just nothing? So it can be charged directly as an expense. If it's, we're talking here about one laptop only, by the way, okay? So don't confuse that. Or another example, which is mostly used in textbooks, is a calculator. Calculators are very small or low in value. You don't have to record them separately. If you have 20 calculators in your business, you don't record them calculator 1, calculator 2, calculator 3, until calculator 20. You can put them in one big thing and charge it as an expense, or you might charge them as one non-current asset. But in other words, items of low value are not worth recording separate, because why? It's a waste of time. You don't hire people to work in accounting just to record one calculator. You know what I mean? So that is an example of materiality. Okay, the last two, you have your historical cost. So in historical cost, we record things in their actual cost. So if you've bought the car in 2015, like this one, we record it every single year, it's still 100,000. Now you might think, but miss, the vehicle will decrease its value over time. That is right. We still record the loss in value of the asset as depreciation, but the cost remains the same. So let's say in 2015, the vehicle cost is 200,000, and it will be the same every single year. Any decrease, I'll put it down, in value is recorded separately. Okay, we will to be discussed further in chapter 12. All right. So, but just make it simple in your mind. Historical cost means we don't change the actual cost of that car if the cost is just losing its value over time. We still keep track of the original amount that we paid for when we first bought that car. Okay. We use that cost. The amount that we spent to buy that car is still there in our books. We don't delete that. We don't change them. But any decrease in the value, we record them separately. Okay? The last one is accounting period. So this is very simple. It simply means that businesses keep a certain accounting period, and usually it is 12 months. Okay, any given month, so it can start. The normal one is January 1, 2019 to December 31, 2019. Or you can start September 1 of 2019, but you will end 12 months after that, which is when? August 31, 2020. Can I start March? Of course you can. You can start March 1, let's say, of 2020. Then when do you end? The day before that. So let's say February 28th of 2021. All right? So that is the meaning of accounting period. I will cut this video now, and then the next part will be the objectives in selecting accounting policy. Take note of these 11 accounting rules. Thank you.